Okay, welcome everyone. Thanks for joining us today for another regulatory update. I'm Jamie Gray, I'm a partner in the Financial Services Regulatory team, and I'm delighted to be joined by Conal Grant and Jake Wilson, who are my colleagues in the team. And you'll hear from each of us this morning as we canter through the agenda. We've deliberately kept it quite targeted in terms of coverage this morning, so hopefully we'll be able to give you some time back at the end of the session. But before we begin, just a few quick housekeeping matters. Please, as you know, should be the norm by now, but it often happens in reverse at least. Please keep yourselves on mute until the end when we're doing the Q&As, if you have any Q&As. And if you have any burning questions in the meantime, please feel free to use the chat facility, which is at the bottom, and we'll try to pick those up at the end too. And finally, this is being recorded, so we'll share a copy of that to the attendees and anyone who accepted the invite but can't join it. So if you miss anything, then you should be able to watch it again at your leisure. So without further ado, let's push on to the agenda overview, if we can. Thanks, Jake. So, a quick overview of today's session. We're first going to start with the FCA's 5-year strategy, and that's setting the regulatory direction right up until 2030. It came out at the end of last month. And then we'll move on where Conal will talk about the Consumer Duty Action Plan, what's changing and when. And then we will talk about the next session that we're having, which is on the 5th of June. And Jake's also going to pick up some other areas that we've been closely tracking, and I think we'll want to talk a little bit more about. Since we sent out the invite for this session, there have been some other recent topics which are probably going to be quite high priority, which will be quite high priority, like the Regulatory Initiatives Grid, the FCA's 25-26 work programme, and the PRA's business plan, also published in April. And so we'll likely pick those up as well. So let's get started. So this is the 5-year strategy, 2025 to 2030. The previous strategy was a 3-year strategy from 2022 to 2025. And we've got on this slide the FCA's new vision, which is quite succinct, quite powerful, and quite ambitious. Deepening trust, rebalancing risk, supporting growth, and improving lives. And the clear message there, I think, is a strong one, that the UK financial services sector is in a good position. We're globally leading in a number of sectors and in others second only to the US. But we need better trust, we need to encourage innovation, and we need general resilience among firms and individuals to thrive. And what we'll see is that enabling growth through careful risk management is the main theme. Emily Shepherd, who's the COO at the FCA, said in a sort of precursor to the strategy when it came out in a November speech, that she recognized that we need to have a debate about what is an appropriate risk appetite in the sector, which I think is sort of telling that the FCA is open-minded in a way about what an appropriate risk appetite threshold should be, and there may be nuances to how that applies. It may not be a blanket threshold, but there's room for debate. Ashley Alder, who wrote the preface to the strategy and is the FCA chair, he acknowledged that going for growth means taking risks. There can be no growth without some risk, and I think in the past there has been a push for avoiding all risks and mitigating all risks. But the tone of this strategy is more about enabling informed risk taking. So that's a bit of a shift. And it's linked with the government's push for rebalancing the system as well. But why now? Well, one reason outlined by Mr. Alder is that the number of people of pensionable age is set to increase by 14% by 2032, and the current system, as it stands with the reliance on cash and savings, may not deliver the kinds of returns that are needed for financial security in later life. So that's why we've got a new focus on rebalancing risk with a view to enabling growth to support that. Another theme that's emerging is trust and collaboration. We talk about deepening trust there. Growth depends on deepened trust in financial firms and the services that they provide to consumers, but also in the FCA, the regulator. And the FCA is at pains to point out that the strategy is built in partnership with a wide range of stakeholders like industry bodies, consumer groups, and individuals. And the FCA has also made it clear that they intend to deliver the strategy with those stakeholders too. So that, again, is another shift in tone and objective to the 3-year strategy that it shared in 2022. That strategy was more defensive and assertive and almost combative in language about tougher supervision and testing the limits of FCA powers. This strategy, in contrast, is much calmer, much more constructive, really, which I think reflects a wider political and economic climate, and should inform the way that firms engage with the regulator. That's not to say that there is no risk. There's a green light for risk. I think it's to say that risk isn't inherently bad, and recognizes that the growth of the economy can't rest alone on the shoulders of the regulator or the government, but it needs all stakeholders to pull together. There's also, I suppose, to that end, a degree of humility in how the FCA has reflected on the first 3-year strategy and how that unfolded. Emily Shepard said that they'd learned from the first 3-year strategy that it takes time to deliver and cement change. And I think what they're subtly saying there is that they've listened, they're adapting, and they're going to be realistic about how long true reform can take. And that's why this is a 5-year strategy and not a 3-year strategy. And the context is key. The FCA has also recognized the big issues that we're all acutely aware of, but the financial sector in particular is grappling with, around increased global uncertainty, demographic change, challenging financial resilience. I think it was mentioned in the strategy that over 7 million people have reported struggling to pay their bills or debts, and many more would struggle to cope with a shock to the financial system based on the savings that they have. There's also a big focus on advancements in technology and the disruption that can bring, as well as the consequences of slowing economic growth. So let's move on to how the FCA will deliver this. These are the 4 strategic priorities. You've got being a smarter regulator, which is more efficient and effective, supporting growth, and that's consistent with the secondary objective of the FCA around international competitiveness and growth, helping consumers to navigate their financial lives, and then fighting financial crime. And I'll expand briefly on each of those over the next few slides. Thanks, Jake. So ultimately, the FCA wants to be a predictable, purposeful, and proportionate regulator. And actually, it was in a speech, I think, last week, that the FCA believes this is something that sets them apart from other regulators, is its proportionate and agile approach. It's not about regulating harder, it's about being more effective and embracing the dramatic technological advancements that we've had to allow it to be more targeted in its approach and smarter. And some of the initiatives that it's pointing out as demonstrating that, we'll just cover those here. There's a detailed firm-specific 2-year supervisory program for the largest firms, and that's going to be scrapped and replaced with something that's much more flexible and tailored to the firm and the situation. Information requests are going to be targeted. The FCA says that those firms seeking to do the right thing will notice that supervision becomes much less intensive. More firms will have direct contact points with the FCA, so more tailored engagement, And we can expect a digitized and simplified authorization process. Anyone who's gone through an authorization or variation of permission process will know that there can be quite lengthy requests for information and detailed verifications, I suppose, of the information that's been submitted so that the FCA knows it's complete. And what they launched last week was a pre-application support service, which has been extended to all wholesale payments and crypto firms to help navigate the authorization process. And the aim of that is to make it easier to apply and facilitate better quality applications, and also ensure that follow-up requests can be reduced too. They're also planning to stop 3 regular data returns, and they say that will benefit 16,000 firms. And there may be more similar initiatives as they uncover the cuts that they can make. MyFCA is a new single entry point for firms where you can file returns, pay fees, and manage core interactions. And that's been quite well broadcast on the FCA's website and in the speeches. And that's all going to be in one place, and again should make it simpler to deal with the regulator and meet regulatory obligations. And they've also said that they'll continue to draw on skills from outside of London across the country, and we'll come on to some more of those later on. So that's being a smarter regulator. And next we'll move on to supporting growth. This links again with the FCA's international growth and competitiveness secondary objective, and it sort of stems from the wider political initiatives and the various letters to and from the FCA with the PM around what more the regulator can be doing to enable growth, while at the same time recognizing that it can't alone deliver on growth, it can enable it. So what the FCA has referred to is about its past support for innovation and also what it plans to do in future. So it referenced the Open Finance Roadmap, and which builds on open banking success, and the National Payments Vision, which will move to the FCA as the payment systems regulator is integrated within the FCA. They're also looking to run AI-focused tech sprints and enhance the digital sandbox infrastructure through things like more computer power, better data, and in general, just taking an increasingly tech-positive approach. The FCA has always been, and the legislation has always been, quite tech neutral, but that doesn't mean that the FCA is going to. I think there's a change in tone from being passive around technology to really seizing what they can to facilitate growth, and it's recognized that technology is where a lot of the growth will be happening. Other areas referenced to around that are tokenization, particularly in asset management. So tech is one key area of growth, and another growth area will come from cutting friction. We talk about simpler rules on the slide there. This is about stripping out redundant handbook requirements. I think Connor's going to talk to some of those, or the recent action plan on that soon. And last week's consultation on removing references to the UK capital requirements regulation for investment firms from the definition of regulatory capital, that should reduce the volume of capital requirements by around 70% in terms of the rules that firms are facing, although the outcome is intended to be the same. It's just the volume of rules and bureaucracy around that essentially should be lessened. And for each of these priorities, the FCA, I should say, has some metrics that they will be judged by. And I think what's quite telling on this one is the metrics point to a shared responsibility with markets, firms, and consumers. They say one of the success indicators will be an increase in the UK's financial services exports and better access to capital for businesses. So that's a shift away from what the FCA can control towards being more of a partner, not just a policeman. Okay, on to the next. Helping consumers. This is about helping consumers navigate their financial lives. And the FCA recognizes that financial decisions can be difficult regardless of your background and how wealthy you are, and the options are quite wide and varied, and it's open to problems and misconduct, but also just poor decision making. And the choices that people make can have an economic impact. They could lead to capital flow into growing businesses, as well as boosting individuals' own resilience. But the opposite is also true, and people with low savings and inadequate support could find that they'll be unable to withstand financial shocks. It's that individual resilience point coming through again. So how does the FCA achieve this priority? Well, right at the top there, we've got consumer duty as the golden rule, and consumer duty, which was part of the previous strategy, is staying front and center. And I think there's no chance that the FCA is going to back away from that now. The consumer duty is very much implemented and central to how consumers are protected. The FCA has also committed to supporting the government as it develops a financial inclusion strategy. It's talking about driving value for money in key sectors like insurance and pensions, and tackling fair value issues. Targeted support, that's part of the new advice guidance boundary review process, and there's more expected on that later this year. But essentially, that's a new regulatory regime for better access to advice style support at the point when segments need it. There's a mortgage affordability rules review, which is with a view to helping first-time buyers. And the metrics for this one are more consumers holding core financial products like general insurance, pensions and accumulation, savings account and current accounts, but also higher customer satisfaction scores too. And finally, we have fighting crime. Thanks, Jake. So the focus on financial crime isn't new. It's not a new priority, and it's just a continuation of something which I think is just inherent to financial markets. And there is a degree of realism in how the FCA is approaching this. And I suppose it's the other side of the coin to the rest of the tone of the strategy, which is enforcement does remain about deterrence. So they do want. We used to hear with the FSA a lot about credible deterrence, and I think the FCA will continue to use enforcement as a tool to put firms off or encourage firms to do the right thing. And priorities for the next 5 years include AML, keeping dirty money out of the financial ecosystem; fraud, cracking down on regulated firms in particular being used as vehicles for fraud. So stopping criminals at the point of authorization is one way of doing that, and that's a priority area they've identified. Keeping markets clean, and also developing a safe crypto regime that protects consumers. I think it was pointed out that a lot of under 30-year-olds had crypto assets as their first investment, and while there may be some merit to that, it wasn't perceived to be the right balance of risk, and so I think the FCA is conscious that that is a vulnerable area that needs to be protected. The FCA is also going to support firms to use new technologies in the same way as supporting growth, but here to support financial crime prevention and systems like anti-fraud and market abuse. There was recently a market abuse tech sprint that focused on the different sorts of technologies that can be used to identify the patterns that will reveal market abuse. And so while these problems aren't going away, the mechanisms for deterring them are also becoming ever more sophisticated. And tone again on this priority, the FCA is keen to work with firms and also share intelligence internationally. Interestingly, they mentioned that the number of criminal charges over the last 2 years has been higher than ever before, and enforcement actions have been faster, but fines have been reducing. steadily from a high of £1.5 billion in 2014 to around 176 million last year. And in terms of metrics at the bottom, I think they recognise realistically that improving market cleanliness and stopping growth in investment fraud and APP fraud is the way to go, rather than seek to eradicate it altogether. So those are the four main priorities. And then I thought it would just be useful to point out some interesting observations since the speech that Emily Shepard made in November last year versus what came out in the strategy. So if we can move on to the last slide on this, we've got the surprises. Global expansion. So the FCA, the FCA is planning to open its first offices in the US and Asia Pacific, which I thought was, I suppose, admittedly, it caught me off guard, but it was slightly surprising that this isn't already in existence, being a global hub for financial services and having been in that situation for decades, if not longer. But this does point to the more international, expansive mindset of the FCA, and I think there was also reference to being cooperative with friendly jurisdictions. So recognizing also that the geopolitical tensions that may be faced in other jurisdictions. But the idea here is to advance UK-US financial services policy and regulatory cooperation, and also to support US firms that are maybe looking to navigate UK regulation. And as we've seen, one of the metrics that the FCA is judging itself by is improving UK financial services exports and inward investments. So they see this as being one way of facilitating that. The other thing was regional investments, and they've spoken of, I mean, in the past, in the business plans, they've talked about growing headcount in Leeds and Edinburgh. They've specifically mentioned that they wish to double the headcount in Leeds and Edinburgh to over 1,000 colleagues in the next 5 years. One other interesting point actually was also ESG and D&I. There's no mention whatsoever of those concepts, despite strong focus still in the industry and among shareholders. Although perhaps that's recognizing a global shift in retrenchment in ESG legislation. We've seen a narrowing of the scope and a delay of CSRD and CS3D in Europe, and recent postponement of SDR by the FCA to portfolio management. So it doesn't necessarily mean that ESG, and I think it's quite clear that ESG continues to be important, but it does suggest a shift in focus, perhaps. The only other one to mention here was open finance. They have specifically mentioned that within a year they intend to publish a roadmap for open finance, and the first scheme is expected to be in place by the end of 2027, with the priority being small business lending. So I think overall, the new strategy, it's pretty confident in its tone. It's a shift towards growth. It's supposed to be supportive. It's enabling informed risk taking to get there, and better guidance for consumers to increase resilience throughout the system. And so that's optimistic and constructive. But I think also the expectations on firms will rise, and will probably rise quite quickly, into being ready for faster action, smarter regulation, and responding to the challenges that brings. And maybe some of that will be new in how the regulator reaches out to firms and requests data, and a stronger focus in general on outcomes that are measurable. So with that all said and done, I will pass you over to Connell, who will talk to the Consumer Duty Action Plan.
Oh, thank you, Jamie. Yeah, that's great. So my name's Connell. I'm a trainee solicitor in the financial services team at Burness, and I'm going to talk a little bit about the FCA's Consumer Duty Action Plan. So, as I'm sure you will all be aware, back in March, the FCA published a feedback statement which set out the immediate areas for action alongside the longer term plans for reviewing FCA requirements following the introduction of the Consumer Duty. And given the nature of the FCA's actions and proposals, and in particular some of them cover known areas of industry challenge, we thought it would be useful to cover the key pieces of the Consumer Duty Action Plan set out in the feedback statement. So to give a little bit of background, this feedback statement follows on from the FCA's call for input back in July 2024, where they sought to understand how they could simplify their requirements following the introduction of the Consumer Duty. And the general consensus of feedback was for amendment or simplification of discrete areas rather than a wholesale review of the handbook. And it is worth me noting up front that despite the amendments and simplifications noted in the Consumer Duty Action Plan and the removal of the requirement for a consumer board champion at the end of February, the Consumer Duty will continue to play a central role in the FCA's rulemaking and enforcement. And to reiterate the message from Jamie just there, the FCA's 5-year strategy does confirm that, underpinning the strand of the strategy relating to helping consumers is this idea of making the Consumer Duty integral to how regulated financial services firms treat their customers. So it's something to look out for. Now, the action plan includes reviewing multi-sector requirements, as well as those which are sector-specific. It has 4 pillars with the aim of achieving 3 outcomes. And those 3 outcomes are more flexibility, more predictability, and improved efficiency. And in this slide here, we have set out a timeline of the immediate actions that the FCA has set out. It's worth noting that the FCA will use an accelerated consultation process for actions where there's clear support for change. And then on the next slide, we will look at other areas of potential review, which the FCA believe require further stakeholder engagement. So the FCA provided more specific dates for some of the areas of immediate actions, and we think this timeline kind of brings to life the FCA's plans, which they set out within the action plan. And I'll talk through it, but we'll run through the items in bold. So I'm going to start down the bottom at May 2025. Now, with mortgage rules, we can expect to see a few changes to the mortgage rules under this programme of work. In May 2025, we can expect a consultation covering proposals to make it easier for consumers to remortgage with a new lender, reduce their overall borrowing costs through term reductions, and discuss their options with a firm outside a regulated advice process. And then further, in June 2025, the FCA will also publish a discussion paper covering topics such as risk appetite and responsible risk taking, alternative affordability testing and product innovation, lending into later life, and consumer information needs. And this is in response to feedback that the mortgage disclosure rules are too prescriptive and limit firms' ability to tailor information to meet customer needs. So do look out for this. On the second point, and it's at the by summer 2025 point on the slide there, commercial and bespoke insurance. So the FCA are planning and consulting by summer 2025 on the proposed options for simplifying the rules for insurance firms that they set out in their discussion paper from July 2024. Following the feedback received, this consultation will also propose further changes to the rules, including allowing firms greater flexibility over how often they review product value under product governance rules. And alongside this consultation, the FCA will also publish a discussion paper looking at reviewing some of the more detailed and prescriptive product-specific rules under the ICOB sourcebook, including those for packaged bank accounts and gap insurance. So moving on, client asset rules. This is in the later in 2025 part here. The FCA will look later in this year at updating certain client asset rules as industry practice evolves. Areas they have highlighted as looking at include broadening reconciliation rules to allow the use of records from sources that were not envisaged when the rules were introduced, and adding flexibility to the rules on removal of interest owed to firms. And we expect these changes will be welcome across the industry. Moving on, just below that, reviewing asset management. assessment of value reporting. The FCA have flagged that later this year they will also look at changes to the requirement for asset managers to report annually on their value assessments, aligning with the FCA's broader approach to value assessments. And we're sure there will be much interest to those in the asset management industry. And then finally, it's right over on the right-hand side. Alongside the Treasury's review of the Consumer Credit Act, the FCA will review the rules for advertising consumer credit, including looking at removing unnecessary prescription in the rules and improving alignment with the consumer duty. And they will also discuss whether to review the rules on APR disclosures. So that's the timeline, Jake, if you can move on to the next slide. Thank you. Now here, I'm just going to discuss the FCA's further plans for reviewing the rules. So following an in-person summer summit, the FCA plans to publish a statement in September this year, outlining their full programme of work in this area. However, in the March 2025 paper, the FCA highlighted various areas that they're proposing to look at further, subject to stakeholder engagement. And I've picked out a few of these areas just to give a bit more detail on, to further help build the picture of what proposals we can expect to see from the FCA in due course, but it's by no means exhaustive. It just gives a good picture of the horizon. So first on the list there, the international application of the conduct rules. Starting with a review within the insurance sector, the FCA proposes to look at whether conduct rules like requirements under the consumer duty should apply to firms serving customers outside of the UK. And this is while these firms are also adhering to the local rules of the customer's jurisdiction. And then further down, retail banking disclosures, the FCA here intends to review and where appropriate remove prescriptive disclosure requirements and make the rules more flexible, allowing firms to tailor customer communications. This will include consideration of requirements of the summary box for savings accounts, which is interesting. And moving down, the reporting requirements linked to insurance pricing rules. Here, the FCA would like to review the reporting requirements introduced under their September 2020 market study on general insurance pricing practices. And second to last point, the clarifying the application of the consumer duty through distribution chains. Here, the FCA will engage with firms on how they can provide more certainty on their expectations under the consumer duty for firms in retail distribution chains, particularly those that do not have direct interaction with retail customers. So this includes how firms should share information within the chain. And we expect the industry will welcome the FCA's engagement in this area, given how information flow across the distribution chain can sometimes be a challenge for firms. It's certainly something that we've been asked about previously. And finally, clarifying rules on product governance and fair value. Here, the FCA will engage with stakeholders about providing more clarity on how the rules on product governance and fair value in the consumer duty interact with each other and with those elsewhere in the handbook. So something to look out for, very interesting things, but that brings me to the end of mine. I will now pass you over to Jake. He's going to give some closing comments and other areas that we will be looking out for in the future. Thanks.
That's great. Thank you very much, Connell. So my name is Jake, and I'm a senior solicitor within the Financial Services Regulatory team. And I'm going to be talking about some of the kind of future developments that we're going to be looking at further down the line, and then a few other points that we've been considering and keeping an eye on that we expect to be happening in and be of importance in the sort of near future. So to start us off, and before we move on to those things, wanted to flag that our next regulatory update webinar, that's going to be on Thursday, the 5th of June, 2025. And again, that's going to be from 10 a.m. till 11 a.m. So we like consistency here. And just to give you a flavour of what we're going to be looking at, our focus is going to be on the regulatory initiatives grid that came out on the 14th of April this year. And more specifically, we're going to cover how the multi-sector initiatives, as well as the priorities for each sector. So this really gives us a chance to look at the big ticket regulatory initiatives that you're going to expect to see in your sort of relevant financial services sector over the next year. And then just to kind of close off this section of the webinar, wanted to flag a few other kind of key areas that we're looking at that we're expecting to have a larger industry impact, but we're not going to be covering these in the next webinar. So to start off, I wanted to talk about the UK and EU move to T+1. So This is following on from May 2024, when the US, Canada, Mexico, and Argentina transitioned to a T+1 settlement cycle. But then in February this year, it was confirmed by the UK government that the UK market's also intending to move to this T+1 on the 11th of October 2027. So it's still some way away, but the wheels are really moving on it already. So this is coming off the back of a publication from the Accelerated Settlement Task Force, on the back of the report on detailing the implementation plan on a UK T+1 code of contact. So in terms of the impact that these changes are going to have, the research that was published by the task force says the implementation plan is going to require firms to accelerate up to 29% of their post-trade instructions for UK trades. So this is showing that there's a bit of a clear government and regulator support for the move to T+1 and the efficiencies it's going to bring to UK markets, as well as the message from the regulators really being that firms should begin to act now and get planning their move to T+1. So in addition to this, in February 2025, the European Commission also has proposed that 11 October 2027 is the date for the EU's transition to T+1. So this proposal is still waiting adoption by the European Parliament and Council, and ESMA have also published a consultation paper covering the technical changes that are going to be required to move towards T+1. And it's beyond the EU, there's also support for this October date within Switzerland too. So what we are expecting is that firms are already starting to review the publications from the task force, and they're starting to map out the impact of these changes and what key steps there are to facilitate this move, and kind of building on how they were prepared for the North American move to T+1 last year. To give you some stats to kind of accompany this, the recent task force research, that came to the conclusion that 62% of global firms are now engaging on plans to prepare for the UK transition to T+1. But 51% of firms felt they need more clarity on the specific operational details behind the task force guidelines, so that they can really prepare in the way that they're going to need to for this transition. So this is something that's really going to be a pretty big industry program of work over the next few years. So it's something we'd absolutely love to talk to our clients about, and for any of our contact to please get in touch if you're wanting to speak to us about this. So then the next up is the UK and EU ESG regulations. So given the focus on ESG regulations over the past few years, it was something we wanted to mention quickly in the UK and EU developments. So despite, as Jamie mentioned, a real absence of ESG in the FCA's 5-year strategy, and the headlines in Q1 2025 that saw huge outflows that were record levels from sustainable investment funds, according to Morningstar data. We still expect compliance to the ESG regulations to be a key part of our clients' day-to-day work in the coming months. And to look at the UK perspective to begin with, at the beginning of April, there was a temporary carve out for certain funds complying with the FCA's SDR naming and marketing rules. And the FCA also noted in February that they hit a milestone of over 100 funds planning to use an investment label. Another Morningstar report published in the early April noted that they had identified 80 UK open and closed-ended funds with an SDR sustainability label and 325 non-labeled funds with sustainability disclosures. Within that, the focus label is really the dominant one, and that's making up 56% of all labeled funds. And what we're kind of finding is the market sentiment is the number of funds adopting the label is actually lower than was initially predicted. And this is perhaps in the fact we've seen a pause on the FCA's proposal to extend SDR and investment labeling portfolio managers. So it's really something to keep an eye on in the next while, and see how the UK sustainable funds landscape continues to evolve over the coming months, keeping in mind the kind of mentions that we've had in the FCA's 5-year plan here. So then casting our eye over to the EU side of things, in February, the European Commission published a really sort of much anticipated proposal that was looking to simplify the EU sustainability rules and reduce the compliance burdens for firms. So this is the omnibus proposals. So within this, there was the Stop the Clock directive, and within this package of proposals, there was a fast-tracked European legislative process that entered into force on the 17th of April. So now member states have until the end of the year to transpose this directive into national law. The Stop the Clock directive has also had substantial impact across the industry as it delays the first entry into application for Corporate Sustainability Reporting Directive, so CSRD. And these are the requirements for large companies that have not yet started reporting, as well as listed SMEs. So this means that the second wave companies, which will now need to report on the previous financial years in 2028 rather than 2026, and third wave companies will now report in 2029 rather than 2027. So buying these companies quite a bit of time now. And then another effect of the Stop the Clock directive is it delays the transposition deadline in the first phase of the application of the Corporate Sustainability Due Diligence Directive by 1 year. And this means the deadline for transposition into national law is now 26th of July 2027. And the first wave of companies will have to comply from 26th of July 2028 instead of 2027. So now that this is enforced, European legislators are turning their minds and scrutinising substantive changes to European sustainability regulations that were proposed under other parts of the omnibus package, and a change that includes reducing the scope of undertakings required to comply with the CSRD sustainability reporting requirements by approximately 80%. So a huge kind of reduction in scope there for European companies. And then, and in terms of our impact on this, we're going to be following the European Parliament and Council's debate on the substantive omnibus proposals, and we're going to be following this really closely. So this is another one. If people want to get in touch with us to discuss this further, please don't hesitate to reach out to the team. And a final one that's perhaps slightly more close to home than some of the EU ESG regulations is the ongoing Motor Finance Commission case. So this is one we've spoken about a couple of times already. And most recently in April, the Commission's case was heard by the Supreme Court now. So this is something that's going to likely have ramifications, not just on broker commission within the motor finance industry, but in all industries where there's a broker commission being paid. And the expectation at the minute is that the judgment's going to be handed down by the Supreme Court in July this year. So in the next few months, that's really something to keep an eye on and be interested to see how that one pans out, given the kind of importance of it in the wider industry. And so with that, I'm going to bring us to an end. And for anybody who's got any questions, we have our Q&A section here for you.
Thanks, both. I don't see any questions coming in through the chat, but do feel free to email us. I think we've got, did we have our contact details on one of the, yeah, here we go. So if you'd, yeah, just feel free to send all of us an email and we'll get back to you quickly. And just a reminder that this has been recorded, so if you would like to have another listen or share it within your institutions, please do. So I think we can probably, absent any questions, give you all back 15 minutes of your time, and we'll see you again next time. Hope that's been useful.